Good morning, and depending on what time zone you're in, good afternoon. My name is Justin Metcalf, and today is the part 10 of 10, the last one of our Pillar 2 technical series, which today we're going to talk about the GloBE rules interaction with the current U.S. tax regime. So. For those that have tuned in, we want to say thank you for those that have tuned in for the past, prior 9 sessions. Thank you for tuning in, and hopefully this wraps up and brings together all the content that we have spoken about over the past couple months. Without further ado, for those that have tuned in and the ones that are brand new, my name is Justin Metcalf. I'm a director with Forvis Mazars US in Charlotte, North Carolina. And my area is, these days I do quite a bit of Pillar 2 and, a lot of international mergers and acquisitions and consulting on that front. So I'm going to let my colleague here introduce himself as well. Juan, take the mic.
Thanks, Justin, and thanks everyone for joining us in this last webinar of this series. My name is Juan Fernandez. I'm a manager in our international tax team at Forvis Mazars. I'm based in New York City, and very excited about they discussing how this GloBE system interacts with our current U.S. tax regime. So can get started.
Awesome. So just before we go into the subject matter, we want to lay out kind of an agenda. So similar with all these sessions, we want to do kind of a bit of a recap, but this one's going to be a little more extensive than the prior recaps that you've seen, just to kind of bring everything back into perspective. And then we're going to shift directly into the February 2023 Administrative Guidance, which talks about GILTI and the blended CFC allocation regime and how that affects the Article 4 covered taxes. And then we're going to dive in right after that into the 4-step process and the 5-step process for, respectively, for allocating current deferred taxes that was laid out in the June 2024 Administrative Guidance that was released last year. And then finally, after we've done that, we are going to go directly into a little bit of an informal panel discussion to discuss, what are the practical implications of the U.S. interaction with the GloBE regime for MNE Groups, and how we can think about how these come into play going forward, and what could be expected. So let's go right into the recap. So for those that haven't tuned in, right, in the first couple sessions we talked about the Pillar 2 top-up tax. It's laid out by this 5-step process where you have to determine your MNE group, and we talked about this in the prior sessions. Once you've determined what your MNE group is and all the constituent entities in there, we then have to determine what GloBE income or loss is calculated under Article 3 of the model rules. Step 3 is then you go into Article 4 of the covered to figure out what covered taxes are applied as your numerator when you're measuring this ETR, and then Step 4 and 5 respectively are plugging in these inputs into a formalistic calculation that's laid out in Article 5, and then determining who gets to collect the top-up tax. So simply stated, right, this Pillar 2 for those that are in there is a top-up tax that's imposed on a country-by-country basis, and there's a process laid out for calculating the top-up tax on a country-by-country basis that must be applied. This is kind of a roadmap on how you execute those steps. So we're going to go directly into the next piece here to discuss what is this top-up tax. So before we go into that, for those that haven't tuned in, if it hasn't been made clear now, we're going to reiterate it again, right? The way Pillar 2 has been set up is it doesn't matter who has enacted Pillar 2 in their jurisdictions, just as long as somebody in your multinational enterprise group has enacted all 3 charging provisions. And we'll talk about that here in a second. But once you've established that component, everybody in the MNE group, multinational enterprise group, has to apply this formula, which is, its own separate mathematical computation to determine who owes a top-up tax. And it's prefaced under this formula where you take your top-up tax liability, which for that particular jurisdiction, it's going to be equal to your current year top-up tax liability, which we'll pivot here to show you what that math looks like. Added on to that is any additional current top-up tax that might have been related to a prior period, less any QDMTT. And in prior sessions we've talked about QDMTT as if it's its own separate charging provision, and in many ways it is, but it's not. It doesn't really apply kind of how the IIR and UTPR apply. It applies kind of first before you get to there, and we'll discuss that here in a second. So, your current year top-up tax is prefaced by this this fancy formula. It's your top-up tax percentage multiplied by your excess profits. Your top-up tax percentage is phrased based off of what the GloBE minimum rate of 15% is, less your GloBE jurisdictional ETR. The GloBE jurisdictional ETR is basically a regurgitation of Article 4 as your numerator, your covered taxes, adjusted covered taxes determined under Article 4 divided by your Article 3 net GloBE income or loss. And that's basically how you determine it. So when you've heard the topic of the 294 different data points being thrown out in the market, and keep in mind, this is a very simplistic view of the calculation laid out in Article 5. But to figure out each and every one of these elements, that's where the 294 data points that's been thrown around in the market plays into. So that's one side of the equation. The other side of the equation is taking the Article 3 GloBE income or loss and then applying your substance-based income exclusion amounts, which is basically a carve out for eligible payroll expenses and tangible assets. And on this diagram, you see it's 5% and 5%. That's eventually where the GloBE rules get to. It starts today at 10% for eligible payroll expenses and roughly 8% for eligible tangible assets, and kind of cascades downward to get to that 5 and 5. Let's talk about net GloBE income. This is our net GloBE income, right? This is the Article 3 component, is dictated by this formula. It's equal to your financial accounting net income or loss. Then what you do is you add on certain book to GloBE adjustments, which we covered ad nauseum in a prior session, and all the different ones that are in there. So for those that didn't tune into that, it's rather robust, the different adjustments you have to make. So it would be highly recommended to recap that if you need to. But once you figure that part out, then you exclude any international shipping income per Article 3. Article 4 now dictates what your adjusted covered taxes are, and your adjusted covered taxes is a little more complicated in that respect, because you're basically taking your covered tax expense on FANL, your financial accounting net income or loss. You're adding in certain additions and reductions to covered tax expense that are specifically enumerated in Article 4. And then there's this mechanism that's designed to address temporary differences, specifically deferred taxes, called the Total Deferred Tax Adjustment Amount, the DTAA. And it's basically, a way to track DTAs and DTLs, mainly DTLs, from my experience, and figure out how they factor into the overall numerator. Because FANL is really, includes a component of deferred and current. So you have to, without this mechanism, it wouldn't really match apples to apples. It would really kind of match apples and oranges. So the GloBE rules are designed to match the taxes to the income, and this is a mechanism that effectuates that. Once you figured that out, then if you have any items in your OCI and equity items, there's a required adjustment, so long as it's not, so long that it should be booked to it. That's required. So, and for those that are, interested in diving more into this, there is a prior session we discussed ad nauseum again on this that it would be highly recommended to look at. This is solely for review purposes before we go into the final topic matter here. Once you figured that out, then you can apply your substance-based income exclusion amount, which is, as we said earlier, it's a carve out for eligible payroll expenses and eligible tangible assets, and it's designed. There's an election that says you can, elect out of it. Again, it's designed. Why you would want to do that is really as if it's too big of a hassle to figure out the data pieces, and it's really not going to matter from a materiality standpoint. That if your GloBE income or loss is lower than substance-based income exclusion amount, or it's close or borderline, it really doesn't make sense in some cases to go through the whole data exercise. So the GloBE rules does give you an out on this. So continuing on, right? That's a breakdown of the top-up tax and the elements that go into the top-up tax and the 294 data points that are used to effectuate that top-up tax calculation. I mentioned earlier, it does not matter, right? The way the Pillar 2 rules are designed is that there's a top-up tax for every jurisdiction in your MNE group, so long as one of the entities in there has all three, a QDMTT, an IIR, and a UTPR. And what gives these rules teeth is the charging mechanisms. And the first one is a qualified domestic minimum top-up tax, a QDMTT, and it's basically a local law, a local minimum tax that follows the GloBE rules by design and structure and outcome that basically gives the local jurisdiction a first crack at the apple of collecting the tax, right? Once that has been determined, right, then there's this thing called the income inclusion rule, which by now I'm sure everyone is familiar with, but let's for the sake of covering our bases, let's go through it. So the way the IIR works is you start at the top of the house where the UPE is centered, and you ask yourself, is there a qualifying IIR in that jurisdiction? For those that are in the US, we know that GILTI is not a qualifying IIR, and we'll talk about that why and talk about the allocation key here in a second. So what the IIR set rules say is you go down a tier until you find a jurisdiction that has an IIR. Once you have found that, then you ask yourself, is there any low tax constituent entities under that IIR jurisdictional entity? If so, the IIR jurisdictional entity will have a crack at the apple of collecting any unclaimed top-up tax per the Pillar 2 rules. That leaves a problem, though, because, as I said earlier, it does not matter which jurisdiction has enacted Pillar 2 legislation, just as long as one in the group has. Here's where that comes into full effect. The UTPR, it operates at an under-tax payments rule, under-tax profits rule. It's been thrown around different terms, but they all mean the same thing. And what the UTPR does is it operates as a backstop to the IIR and the QDMTT. It basically says anybody in the MNE group that has not been topped up by the IIR or the QDMTT will be topped up by the UTPR through a mechanism that basically allows either the jurisdiction to collect an additional top-up tax liability, depending on how the UTPR is phrased for that particular jurisdiction, or it has a mechanism that allows the jurisdiction that has a UTPR to deny sufficient deductions to top up any delinquent constituent entities. So, we're going to go through an example here real quick to bring this home. So let's use this very simplified example. Let's pretend Bermuda does not have the minimum tax they had before. They have a 15% minimum tax that's been used. So, but we're going to pretend it's a zero rate. So if we apply that logic that everybody in the multinational enterprise group is subject to Pillar 2, just as long as one jurisdiction is enacted, all three, we're okay. We have to go through the mechanics. So going through this, right, we know UK, Dutch GloBE, and Canada have all enacted all three in this example. Bermuda and the US have not done anything. So we agree everyone here is going to be subject to a top-up tax, and first crack at the apple comes a QDMTT. Based on that, UK, Netherlands, and Canada will all get their ability to top themselves up using, if they owe anything under the Pillar 2 rules, through a QDMTT. Right, that leaves Bermuda and the U.S. that have not been subject to the Pillar 2 rules just yet. So, as I mentioned earlier, right, what gives teeth to the rules is the charging mechanism. So we know the U.S. does not have an IIR today because GILTI is not an IIR or qualifying IIR per the model rules. So you go down a tier. And we see that Dutch GloBE, Netherlands, has enacted an IIR and it directly owns Bermuda. So what's going to happen is Netherlands, after collecting its own QDMTT for its own local jurisdiction, will now be able to collect the tax that Bermuda should be paying under the OECD model rules. Once that's been done, that means that the U.S. is the only one in our structure that has not been topped up. So, as can be predicted, the UTPR will come into effect, absent any safe harbors that I'm sure everyone here is aware of, the UTPR transitional safe harbor and any other safe harbors that are adopted later. So what that means is that UK, Dutch GloBE, and Canada will basically top up the U.S. to ensure that everybody in the UPE group has been topped up and compliant with the Pillar 2 rules. So without further ado, let's do our first polling question. Which charging provision affects the constituent entities in your MNE group the most? And there's a question here, is there not a safe harbor that if a country has a QDMTT, then the IIR and the UTPR is turned off for other countries? So there is a QDMTT safe harbor that was released in the June Administrative Guidance of 2023 that basically, so QDMTTs are a little bit tricky. So QDMTTs are basically by design, designed to ensure that the local jurisdiction collects its Pillar 2 tax and someone else doesn't collect it. There is the QDMTT safe harbor that says, just because you have a QDMTT does not mean that you may not have to do the top-up tax. So what's required, and actually in the June 2024, the January guidance, that came out recently in 2025, they released jurisdictions that meet the QDMTT safe harbor. And it's basically all of them that have enacted QDMTTs for the most part. But if you meet a QDMTT safe harbor, it means once you've calculated the QDMTT, you don't have to go to the next level and calculate the top-up tax for that QDMTT jurisdiction, because any differences from FX rates or stuff like that are immaterial or nominal. So so there is a QDMTT safe harbor for that that comes into effect. But there's a variety of safe harbors, and if you're interested in learning more about that, we did have we did have a couple sessions in the prior 9 that cover that subject matter. So we're happy to answer any questions if you have any follow-ups on that one. So it seems like quite a bit think the QDMTTs, and another bit say it's not applicable. So okay, good answers. Yeah, I think the QDMTT is likely the one that affects the most, just judging that most jurisdictions will be adopting it. Let's keep going here. All right. So without further ado, let me kick it over to Juan. Juan's going to take us through the blended CFC allocation key for how it affects the most prevalent regime in the U.S. today, known as the Global Intangible Low Tax Income Regime, the GILTI regime. So, Juan, take it away.
Thanks, Justin, and thank you for that recap. Very complete. And yeah, we really appreciate that. So, as Justin said, right, today I will be walking you through an important subject here in relation with the interaction, right, between the GloBE rules that Justin just described and the current US GILTI tax regime, right? And this subject is the allocation of taxes under a blended controlled foreign company, or CFC, or blended CFC tax regime, right? So here our focus will be on Article 432C of the GloBE rules, which ensures that taxes are allocated properly between jurisdictions for the purpose of the ETR calculations. So now, if that sounds complex, don't worry. The idea is we will break it down step by step so that by the end of this discussion, you will have a solid understanding of what blended CFC tax regimes are, why they matter, and how tax allocation works under these rules. So let's just start with the basics. A CFC tax regime is a tax system where income earned by a foreign subsidiary is taxed in the country where the parent company is located. This is designed to prevent companies from shifting profits to low tax jurisdictions. Article 432C of the GloBE rules mandates that these taxes be allocated from the constituent entity owner that is subject to the CFC tax to the constituent entity generating the income, right? So in simple terms, it ensures that taxes are matched with the income that generated them, helping calculate jurisdictional ETR correctly. Things are kind of straightforward when a constituent entity owns only one CFC, but complications arise when dealing with a ultimate parent entity or UPE that has several CFCs located in several jurisdictions, and the constituent entity is subject to a blended CFC tax regime. So just to briefly discuss what a blended CFC tax regime or like a blended CFC tax regime differs from a traditional CFC tax in that it aggregates income, losses, and creditable taxes of multiple CFCs under a single calculation, right? Instead of applying tax rules entity by entity or country by country, as the GloBE rules propose, like a blended CFC tax regime looks at the group's overall foreign earnings. So a perfect example, of course, is the US GILTI tax regime. We may know that under the GILTI regime, all foreign subsidiaries' income is combined, is blended, and if the overall effective tax rate is below a certain threshold, that if we take into account the 250 deduction and the haircut that we have with respect to indirect foreign tax credits, this threshold will be 13.125% in the US. So if the effective tax rate is below this threshold, then it is likely that US tax is going to be imposed under the GILTI regime. So this system ensures that the entire pool of foreign income is subject to a minimum tax level. As you can see, there is a fundamental difference between GILTI and the GloBE rules, right? So GILTI applies globally, meaning U.S. companies aggregate profits and taxes across all jurisdictions rather than calculating tax liability country by country. This country by country rule was indeed included in the GloBE rules. So in general, this creates a tension, right, between the U.S. and the countries adopting Pillar 2. And the quick question here is, should GILTI be recognized as a valid equivalent to the new global minimum tax? And as Justin mentioned, the short answer is no, at least not now, right? Of course, like in the U.S. Congress, some argue that it should be considered. Others say that without any adjustments, it will not be considered. And I think that at this point of the discussion, we all agree that under the current rules for GILTI, it is likely that it's not a qualified IIR. So we have some challenges here, right, for U.S. multinationals. The first one is like double taxation risk. There is exposure, right? Because U.S. companies already paid, like U.S. multinationals already pay taxes under GILTI, but they may still owe additional taxes under Pillar 2. So what was the response? The response was a relief, like a temporary relief, right? So some relief has been proposed, and the idea is that it allows a temporary credit for GILTI taxes, but the key point is that it is only for 2 years and with certain limitations, right? So it will this relief only applies to taxpayers with calendar for 2024 and 2025 calendar years. There is also an important point here, and it's with respect to a confusion that may arise with respect to covered taxes, because not all taxes paid under GILTI may count as covered taxes, as also Justin mentioned, under Pillar 2. So it means that like U.S. multinationals might not get full credit for taxes paid under GILTI, and a key issue here is that even more complex, or the CFC, the US CFC regime gets even more complex when you also consider Subpart F income, right? So this guidance, this relief, was kind of the idea was to address specifically GILTI, but we are still missing some guidance with respect to the Subpart F regime. So as a general matter, because blended CFC tax regimes don't tie tax amounts to specific entities, allocating those taxes to the right jurisdictions for GloBE calculations, this becomes just a challenge. And to address this issue, right? Again, we were provided with a relief, and we are just gonna briefly discuss this relief, like the high level or an overview of the calculations here. So, a simplified allocation methodology has been agreed upon for a limited time again, and the idea is that this method helps distribute the CFC taxes incurred under a blended CFC tax regime to jurisdictions with a GloBE jurisdictional ETR below the applicable rate, right? So if we see the next slide, yeah, we see this slide, right? We have three key concepts here. So we have attributable income of the entity, right? So this is the portion of income assigned to an entity under the blended CFC tax regime. And here it is important to highlight that the definition of constituent entity is essentially the same as the definition that we have for GILTI purposes as tested unit, right, under the current regs. We also have key concept of applicable rate, which is the minimum tax rate under the blended CFC tax regime. So again, for GILTI, we will be talking about 13.125%. And the GloBE jurisdictional ETR, that is the jurisdiction's effective tax rate before considering any CFC taxes. So what's the idea of this formula that we have here, right? This formula ensures that more tax, or that's the idea, is that more tax is allocated to jurisdictions with lower ETRs and higher amounts of attributable income, right? This makes sense, like logical, from a logical and administrative perspective. The guidance, that is specifically the February 2023 guidance, right? They provide the guidance also provides some examples, and we were actually discussing those examples with Justin because they are useful, but you still have some questions after reading the examples. But the idea is that if you look at the guidance, right, you will find a scenario where you have UPE that has several three CFCs located in different jurisdictions, and those CFCs, only one of them is subject to a tax rate, an ETR that is above the threshold, and the other two are located in jurisdictions that are below that threshold. They also use GILTI as a reference. So the idea, after you look at the calculation or the computation, is that you will see that those jurisdictions, right, that are below that threshold, that again is 13.125% in that example, those the CFCs allocated to those or located in those jurisdictions get allocated an additional portion of tax according to this calculation. So just like as to conclude, or to kind of highlight some conclusions here, right? So we have that we have a key difference between what our GILTI or any blended CFC tax regime is and the GloBE rules, and how important this country by country rule is, right? We also have another conclusion, is that relief was provided, right? Although it is temporary and is limited, so we will still see what happens after, like whether they extend it or whether they decide to, to at some point determine that the GILTI is a good qualified IIR, which I don't think that is going to be the case, but still it's a possibility. And again, I think that as a conclusion also for the audience is that U.S. multinationals need to prepare for Pillar 2. And even though the U.S. is not adopting the system itself, and there is still ongoing pressure, right, for changes to GILTI and the U.S. tax rules, and probably those adjustments will not be made. So we will see what what happens. But the idea, of course, is also for GloBE is to prevent profit shifting, but also ensure fairness, right? Including being fair with like with the U.S. multinationals that are already subject to a regime as like GILTI. So I don't know, Justin, if you want to make any.
Yeah, yeah. Thanks for that, Juan. And you know, I think what you mentioned there about thinking about the blended CFC allocation regime, right? And this is something that's temporary, right? We don't, it gives by design it gives the current basically companies in GILTI today under the current GILTI regime kind of this temporary qualified IIR treatment, quasi temporary, because it basically adds a benefit where you can allocate taxes paid on GILTI to entities that are below, entities with tested income below that 13th and an 8th. That between everyone here, somewhat doesn't make sense, because if you think about the Section 78 gross up and the scale back of the FTC, it really gets down to 10.5. So. But the OECD model rules and the February guidance kind of alludes to this 13th and an 8th. So that's why it's 13th and an 8th and not 10.5. But there are, I think one thing is it's important to note here is that, and we'll talk about this more in the panel discussion at the back end, is there some distinct differences on how the OECD and the writers that wrote some of these rules, understand how our U.S. tax code works and the regulations on that. So we'll allude to some of that here, specifically on this GILTI tested unit concept versus transparent interest. So without further ado, though, I know everyone here wants to get their CPE, so let's go to the second polling question here. So what topic would you like to see be discussed in the near future? So this may be our 10th session of 10, right, of the technical series, but we do plan on hosting a number of a number more of these Pillar 2 sessions due to popular demand. So we really would like to get some feedback here on topics that you guys that and everybody that has tuned in here would like to hear more about, that we can structure in the form of a CPE webinar. So and thank you again for those that are tuning in. We know your time is precious and valuable, so and it means a lot that you take time out of your day to come join us. So give you all a second there. Seems like the joint US TCJA Pillar 2 modeling is a hot topic, as well as the GloBE information return filing and qualified CBCR. Okay, yeah, so it seems like we got quite a bit of quite of a mix. So maybe we'll have to dial back and put together some more webinars going forward. Thank you for that feedback. So without further ado, let's kick off. So at this point, we've discussed how you allocate taxes under the blended CFC tax allocation regime for GILTI. What we're going to pivot now to is to the June 2024 Administrative Guidance, which talks specifically about what do you do with current tax expense when you have general basket. In the U.S. we have 4 different baskets that are common in this realm. And there's different rules for the FTC limit. So what do you do under that? So in the June 2024 Administrative Guidance, we got quite a bit. We're going to first start with current cross-border taxes. So when you have cross-border taxes paid between different CFCs or different entities under a parent entity, right, or a main entity, however they define that, they use interchangeably. There's a specific allocation mechanism that's provided in the June 2024 guidance for current tax expense, so that you get credit for that with respect to your adjusted cover taxes under Article 4. It requires kind of a split of domestic income versus foreign source income by jurisdictions, understanding inclusions and remittances and all that fun stuff. Again, this is to be interpreted separate from the blended CFC tax allocation regime. And, so GILTI is a blended CFC tax regime. It's arguable that, our subpart F regime and our foreign branch income regime in the U.S. today, post TCJA, isn't really a blended CFC allocation, isn't really a blended CFC regime by nature what the OECD has deemed it. So they gave us this to kind of help tie kind of the loose ends with respect to general basket, passive basket, and foreign branch income. It's designed to address basically cross-crediting FTC regimes, very much like the U.S. today. And they give us this 4-step method that we're gonna decipher here in steps. So as you can see, there's 4 steps to push it to taking the current taxes that's booked at the parent entity and pushing it down so that the different jurisdictions under that parent entity get the relevant credit for their adjusted covered tax computations for Pillar 2 purposes. So the very first thing for current tax expense when you're pushing it down for cross-border CFC regimes is you have to determine foreign source income tax by the main entity and parent entity. It's defined to include income of domestic entities to the extent that the main entity, parent entity jurisdiction considers the income itself to be foreign source under its own sourcing rules, and subject to an FTC regime. Now, there's a little bit of distinctions here, right? So there's a good example in that guidance where they talk about what do you do about net, right? So they're thinking about foreign source income in the concept of net foreign source income. So that means gross foreign source income, net of allocable expenses. For those that are in the U.S., we have a very complicated 861 to 865 expense allocation and apportionment regime. For 904 purposes, specifically an interest expense, you have to apportion. You generally have to apportion that on the basis of assets, unless you fall around the -10 direct allocation rule. So one thing that is important to note when you're doing this, right, is you have to think about what the expense allocated is for GloBE purposes, not foreign tax credit purposes, when crafting this foreign source income. This inevitably will lead to mismatches because and this is something I think that the OECD in time will have to reconcile however this goes forward. But if you have 300, let's just say you hypothetically have $200 of foreign source income, right, that's subject to this regime, and under the U.S. tax regime you have $150 of expense, and you have net 50 foreign source income. But for GloBE purposes, it's only 100. It's net 100 for GloBE purposes. GloBE supersedes the local jurisdictional expense allocation regime when determining this. So I think that's a very important distinction to make. And again, the income here must be well, we'll get to the next piece here, but step 2, so you first craft up what your foreign source income allocation is, and you have to think about the expense allocation for Pillar 2 purposes, right? The next step is a little bit easier. Well, I shouldn't say easy, but there's this component that you have to compute your allocable covered taxes, right? And it must end up being a net positive amount, because if it's a negative, then there's no allocable foreign taxes to be pushed down, right? So it must be a net positive. And it's determined by a mechanical formula that you see in front of you here. What you basically do is you take your allocable covered tax in that jurisdiction, right, that's booked at the parent entity, right? The total current tax accrued by the by the main entity or the parent entity, and you back out any non-foreign source any non-foreign source tax liability. So in the U.S., you would back out your U.S. tax liability, right? And then after that, you back out your blended CFC taxes. That's your GILTI taxes here, right? Anything residual is deemed to be subject to this regime, right? And there's this. I wanted to note there's this nice little snippet in the rules that talks about the qualified refundable tax credits and marketable transferable tax credits, which are treated as QRTCs under Pillar 2 rules, and certain pieces for qualified flow-through tax benefits. So in there's talks about adjustments you have to make to your base, so that you have a kind of a consistent GloBE treatment. So for those that do have this, I would highly recommend that you dive into that component there. So for the interest of time, we'll keep moving forward, right? Once you've determined that, then what you do is you now determine your cross-crediting allocation key for the permanent establishment or the constituent entity CFC below it, and for the main entity and parent entity. And that's basically phrased by basically the same exact computation as you see in front of you. You take the taxable income of each relevant party here, and you multiply it by the applicable tax rate. And the applicable tax rate is basically what that entity is subject to tax to in that jurisdiction. And then once you've done that, you back out your creditable foreign taxes on foreign source income, right? So this is determined after FTC. Once you've figured out your PE allocation key and your main entity, parent entity allocation key, now what you can now do is take the total allocable covered taxes by entity and then apply this formula by using the numerator being your cross-crediting allocation key divided by your total cross-crediting allocation keys. So what you're basically doing is figuring out what your post-credit FTC, your post-credit taxes are concentrated at each player in this equation, lumping it up and then pushing it down, very similar to how you would think about it under 1502 principles in the U.S., but it's adopting it from an OECD perspective using this allocation key. So without further ado, in the interest of time, so we can get to the panel discussion, I do want to talk. Let's go quickly through the allocation of cross-border CFC taxes in the context of deferred tax expense. And this, for those that tuned in earlier, right, this really plays to the DTAA amount that was discussed that addresses the temporary differences. And in here, there's provided a 5-step approach for the CFC tax regime, right? There is an election where you can basically say, I don't want to apply this and I want to forego doing this 5-step methodology. And it's a 5-year election that you make on a jurisdictional basis. So, keep that in mind in your back pocket if you don't want to go through this exercise, but there is an election for that. It's a new one that was added to the June 2024 guidance. And, it's applicable to MNE Groups, the main entity and PE structure. And again, like the current cross-border CFC tax regime, this does not include blended CFC taxes because that's allocated through a different mechanism. So let's go through this. So here's the 5-step process. It involves you can read the slide here, but basically what this methodology is laying out is it's saying, okay, I need to categorize my DTAs and my DTLs recorded at the parent entity or the main entity with respect to the assets and liabilities of constituent entities under it. And they want you to do it based off 3 categorization codes, which we'll go through in a second. Once you've done that, right, there's a step 2 that requires and this only applies if you book your DTAs and DTLs on a net basis. There's this requirement that you deconsolidate your DTAs and DTLs from any FTCs that have been applied to that, and we'll go through that here in a second as well. Once you've done that, then the 3 categories that you do in step 1 is you craft these based off what's excluded GloBE income, what's passive GloBE income, and keep in mind there's that Article 4.3.3 limitation that applies to the passive GloBE income, and then you also categorize it based off non-passive GloBE income, or for simplicity's sake, let's just call it general GloBE income. So let's go through this step methodology quickly here, and then we'll go into the panel discussion from there. So step 1, you categorize your DTAs and DTLs, right? And you do this, so the one thing you have to do is you have to identify them, obviously, with respect to the assets liabilities. You also want to understand the movement of them, because when they flip, you might have to make certain corresponding adjustments per the June 2024 guidance. Once you've done that, you want to categorize between these 3 categories that I mentioned earlier, excluded GloBE income. We'll talk about that here in a second, because it seems a little bit like that could throw some people off. It's not going to apply to your GloBE income calc, but they want you to craft it for purposes of monitoring GloBE attributes. And then you seclude it down to passive and general GloBE income. So that's the easy one there. The second step is a little bit tricky, and let's take this in pieces. So it only applies if you book your DTAs and DTLs on a net basis, right? If you do, right, then this is how they give you some discussion on how you deconsolidate. And there's a step 2A and a 2B. Step 2A is you determine your parent entity's pre-FTC posture, right? And basically what it's saying is you want to calculate your pre-FTC deferred tax expense or benefit arising under that CFC regime in which it applies. The second part, and this is our step 2B, right, is you want to determine your relevant credible foreign taxes, right? And in doing that, right, what it says is you need to calculate any credible foreign tax which would be available absent the FTC limit in the local jurisdiction to offset the expected pre-FTC expense, right? And this is how they give rise to this relevant creditable foreign tax definition. What it really is it's any basically credible taxes, including carry forwards, right? Not limited by any FTC limit. And then there's also this other part where there's this like reasonable allocation of excess foreign tax credits arising from sources of income which are available for use against that basket of income coming in, right? This addresses the cross crediting in the same basket piece. So general basket today allows you to take subpart F taxes and cross use that with other general basket 901 credits. So this is a mechanism for addressing the relevant cross crediting regime that's discussed in the U.S. rules, right? Once you've done this, you can now then start pushing it down to the different baskets that are discussed. So let's go through that. So step 3, what they basically say here is that we want you're going to take you're going to allocate the deferred tax expense or benefit to excluded GloBE income, right? That's what you're going to do. And what that means is, this excluded income, the taxes and the income will go to the same basket. And then from there, if you conceptualize this, it's as if you're throwing it into the trash can and it never comes back again, right? And it does not come into the GloBE income because it's excluded, right? That's the third step. The fourth step is a little more complicated. And I mentioned earlier, step 1, you want to track the movement in your DTAs and DTLs in each period, because this is what's going to affect the allocation on an annual basis when you're doing this. So, what Article 4.4.1a requires a full push down of your deferred taxes from the main entity to the constituent entity level. And this is where the genesis of this comes from. And what you're basically going to do is apply this formula. You're going to take your CFC's constituent entity deferred tax expense inclusion, right? This is basically what's going to adjust your DTA for Article 4. You're going to do this by tracking the movement, right, between your gross CFC tax DTL and DTA that's been determined if you're in a net basis piece in step 2, right, when you have relevant credible foreign taxes and then your pre-parent FTC posture. And then what you're going to do is you're going to back out any relevant credible foreign taxes from that base. So that's basically your 2B that's being backed out of the base. 2A is a good thing. 2B is backed out, right? And then that's pushed down, right, to the non-passive or general basket GloBE income category. Step 5. So before we go into step 5, let's do a quick polling question. And before we go into step 5 here, we'll give everyone time here, or maybe we can just jump over that here so we can wrap this up and go into the panel discussion. For step 5 purposes, right? We're gonna what then happens is, so I mentioned earlier, Article 4.3.3 has this a limitation on adjusted covered taxes that apply for Article 4 purposes for passive GloBE income, right? And basically limits that allocation, right? What happens here is step 5 then says, right, if you have excess tax expense related to passive GloBE income after the 15%, the excess is allowed to be treated as a new deferred tax expense and possibly new current tax expense, subject to the limitation or Article 4.3.3. If it's below the 15%, then it's just simply pushed down and put in the passive basket there. keep in mind, this does not apply with permit. This one step applies only with constituent entity CFCs. It does not apply with permanent establishments. So in the interest of time, we're going to go right into the panel discussion. Let's, so let's, I want to dial this back a little bit because we covered quite a bit of content here. We talked about the blended CFC allocation key. We talked about the current pushdown and the deferred pushdown in the June 2024 guidance. But, since this is the last session, we do want to consider, what does this mean from Pillar 2, right? How do you apply all of this, right? And what are we seeing in the market today, right? From a year-end provision standpoint and preparing for filing the GloBE information return. So, I think an important piece here, right, is to think about what is in charge. When I say understanding what is in charge for Pillar 2, this is understanding the charging provisions that we discussed earlier, right? Which jurisdictions have a qualifying, which jurisdictions have enacted IIRs and QDMTTs today, right, in the EU, right? Looking at your structure and saying, okay, who's gonna have to comply with running through the full scope calculation or the transitional CBCR safe harbors that we discussed, and coming to an agreement with your auditors in the context of a provision audit, right? Of what are the where are the jurisdictions where you're actually going to have to test, right? And eventually it's going to have to evolve because we know 2025 there's jurisdictions that have already enacted UTPRs. I think we saw Indonesia most recently enacted a UTPR via regulation. So we know the UTPR is here. South Korea was the first, I think, to do that. So understanding which jurisdictions have adopted which charging mechanisms and how that applies to your structure is going to be very, very important. Just getting past that. The second piece here is, you want to have a plan for when you file the GloBE information return in 2026. So for a lot of calendar year taxpayers, based on the current layout of the model rules, you're going to have to file that by June 30th, 2026. And, if we know that the data could be relatively onerous. So having a plan on how to find those data points and having a plan starting today, if you haven't already, I think for the GloBE information return for the jurisdictions where you will have to file will carry a lot of weight going forward. There is this third piece that we also want to talk about, which is monitoring your transitional safe harbor testing and qualified financial statements posture. So for those that have tuned in prior sessions, right, there is this transitional CBCR safe harbor that many are applying today, and it's kind of where they can, right? There's some entities are not allowed to apply that, but the ones that are, there's mechanisms you want to consistently be monitoring. Well, do you have qualifying financial statements with respect to those jurisdictions today, and that meet the OECD standards under the December 2023 Administrative Guidance and other pieces of the model rules. But then B, right, we know that the transitional safe harbor test is here for at least 3 years, right? I think in 2024 it was 15% for the ETR test. It graduates to 16% now for the 2025. So when quarterly provision starts for 2025 and year-end provision for 2025 next year happens, for those that are calendar year taxpayers, you will have to test the ETR test under a 16% threshold based on what the 2022 guidance says. So, I think the key takeaway here is you want to monitor these updates as we end the transition period and enter into this world where we are full scope GloBE. There's another piece here of being, mindful about your transactions and Pillar 2 election timing. So for those that tuned into the Pillar 2 elections, presentation a couple weeks back or months back, time is a lost attribute here, or concept of that. But we did cover a variety of different Pillar 2 elections that can be made, but the one that most constantly comes to mind is the GloBE loss election that is only allowed to be made on the first GloBE information return. So understanding what that, what posture the GloBE loss election helps a particular jurisdiction versus claiming the DTAA will, is a key thing that, we would highly recommend, companies to consider as you're on your Pillar 2 journey. And then, we have these last two, and I think this is the part that I wanted to hone in earlier on, right? Is understanding the role of defined terms in the US tax law and the GloBE model rules for applying Pillar 2 computational methods. So, there's this, so as Juan mentioned earlier, right, we have the blended CFC allocation key, which, looks to attributable income based on tested income at the tested unit level and the CFC level, right? For those that are, US tax, GILTI specialists and understand how the GILTI high tax exclusion works under Reg 1.951A-2C7, they talk about what makes a tested unit, right? That it could be a CFC, it could be a branch of a CFC, it could be a basically treaty jurisdictional entity to that CFC. But if it doesn't meet the narrow definition of what a tested unit is, it's a transparent interest by definition. So understanding what a transparent interest is in your M&E group is versus a tested unit is going to be pivotal when you're thinking about doing the blended CFC allocation key, because transparent interests which may have a different jurisdiction than another jurisdiction in your structure may end up saving you quite a bit of top-up tax allocation for the blended CFC allocation key. So paying attention to details like that, I think, are going to be pivotal going in. And then there's the last part, and I think this is the most important one, is understanding how, the interplay between GILTI and GILTI high tax, as well as CAMT BEAT and the Pillar 2 blended allocation key with the GILTI high tax, is going to be pivotal for understanding whether, how to get to the best overall tax answer, right? Because, we've seen scenarios in our case where, you can make the GILTI high tax exclusion, and you might be thinking you're saving quite a bit of money, right, in the grand scheme of things, but due to the blended CFC allocation key, you lose that tested income at that tested unit, and then it ends up being that you have a top-up tax, right? So understanding what that safety, that nice mix is, but to get to the right answer and most efficient answer for your organization is going to be pivotal when you're thinking about collective modeling of these provisions. So having the infrastructure for that is going to carry a lot of weight going forward. So I think let's, for the interest of time, I think we're at time. So let's go to the fourth polling question here. Have you considered how the blended CFC allocation key affects your GloBE computation? So, I think that concludes our session here on, the U.S. tax regime and how it interacts with Pillar 2 and things that companies should be thinking about going forward, having this information at your disposal. So, as we're wrapping up this discussion, I just, I do want to say thank you to everyone here that has tuned in, for all 10 sessions. And even if you haven't tuned in for all 10 sessions, taking your time today or other parts of other sessions in your day, right? We really do, value your time, and we know you could be anywhere else. So we thank you for tuning in, and we hope you found these, this technical series helpful. And for those that have tuned in, I don't think this will be the last you hear of us. We're working on some more good material coming out, but we do want to say, on behalf of Forvis Mazars, thank you for your time, and we hope you enjoyed this series. Seems quite, don't find it applicable today, and then quite a bit no. So, okay, well, that said, we want to say thank you to everyone. And, if you have any questions or would like to discuss more on this, we're at your disposal. And thank you for your time.
Thanks, Justin, and thanks, everyone.